Welcome to the Deep Dive, your shortcut to being well-informed. Today, we're really getting into the weeds on tax planning, specifically how that 2017 Tax Cuts and Jobs Act, the TCJA, totally shifted things.
Hmm.
It brought in that $10,000 cap on your state and local tax deduction, the SALT cap. Now, for high-income folks, especially if you're in a state like New York with high taxes, well, this was huge.
Oh, absolutely. Not minor at all. We're talking average differences of what, over $43,000? It really stung.
Exactly. And this is where it gets kind of fascinating. States didn't just sit back. They came up with a pretty ingenious workaround, didn't they? The pass-through entity tax, or PTE.
They really did. Quite creative and fast.
Yeah.
And the IRS, they sort of gave it their stamp of approval with Notice 2020-75.
Okay, so how does PTE actually work? Break it down for us.
Sure. So basically, pass-through entities, think your S-corp, your partnerships, they can elect to pay the state income tax at the entity level.
Not the individual owner paying it directly.
Precisely. And because the entity pays it, that payment becomes a regular business expense for federal tax purposes.
Which means it bypasses the individual's $10,000 SALT cap. Clever.
Exactly. It sidesteps the cap entirely. Then you, as the owner, typically get that money back on your state return, either as a credit or some kind of income subtraction. It effectively shifts the deduction.
Okay, sounds almost too good to be true. So where's the catch? I assume it's not that simple.
Huh? Well, tax law, never that simple. While, over 35 states jumped on board, they all did it slightly differently.
A patchwork, you mean?
A total patchwork. Who's eligible, how you make the election, and crucially, how you get that offset back on your personal return is a credit, a subtraction. It varies wildly state by state.
Right. And if you operate in multiple states, I can see how that gets messy.
Oh, incredibly messy. That's a huge risk area. You could genuinely end up with double taxation if you don't carefully navigate those different state rules. It requires real coordination.
Okay, so state variations are one big complexity. What else should people watch out for?
Well, there are some pretty significant potential pitfalls just within how PT impacts the entity itself.
Like what?
Okay, so for starters, making the PT payment reduces the income that flows through to you on your K-1. That directly affects your tax basis in the entity.
Your investment cost for tax purposes, basically.
Right, which impacts how future distributions are taxed or if you sell your share. But for S-corp, there's an even bigger one. The one class of stock rule.
I've heard about this. It's pretty strict for S-corp.
Extremely. If the PT election somehow benefits certain shareholders more than others, maybe because of different state tax situations, the IRS could argue you've created a second class of stock.
That don't mean?
An involuntary termination of your S-corp status. You default back to being a C-corp, facing potential double taxation, corporate-level tax, and tax on dividends. It's a disaster you want to avoid.
Definitely sounds like a disaster. Any other entity-level traps?
Yeah, there's also financial reporting to think about. Under GAAP, standard accounting rules, you have to decide, is this PAD payment an expense hitting your net income? Or is it more like an equity distribution to owners?
And why does that choice matter?
It can affect things like loan covenants, which often key off net income, or even how your business is valued, so not just a tax issue.
Wow. Okay, so entity structure, basis, S-corp status, accounting. What about just a day-to-day operations? Are there traps there too?
Absolutely. Missing deadlines is a big one. These PTD elections often have very strict, sometimes early deadlines, and estimated payments can be tricky.
You mentioned California earlier.
Yeah, California is a prime example with their prepayment trap. To even qualify for PTET in a given year, you must pay the greater of $1,000 or 50% of the prior year's PTT amount by June 15th.
June 15th. That's early.
It is. Miss that date, even by a day, or pay the wrong amount, and you lose the entire PT benefit for that year. No exceptions.
Ouch. So this isn't something you just figure out at tax time?
Not at all. It demands active management, pretty much year-round. You need to be on top of estimated payments, election deadlines, making sure you don't accidentally double count the deduction somewhere.
And all this is happening against a backdrop of potential changes in Washington, right? What's the latest there?
Well, Congress keeps talking about it. There were proposals, you might remember, under the One Big Beautiful Bill Act, or OBB. One idea was raising that SALT cap significantly, up to $40,000.
$40,000? That sounds like a big improvement.
It does, but, and this is key, it came with a pretty aggressive phase-out, starting at $500,000 of modified adjusted gross income, MGI.
Okay, so MGI, explain that phase-out bit.
Right. MGI is a specific income calculation. Once your MGI hit $500K, that potential $40 K cap would start shrinking pretty fast.
Mm.
For many higher earners, it wouldn't have helped much.
Interesting. And wasn't there also talk about blocking certain types of businesses from using PT?
There was, yes. An early version proposed disallowing PTT for what they call specified service trades or businesses, SSTBs. Think lawyers, accountants, consultants, doctors.
So professional services, basically.
Exactly. Businesses where the main asset is the skill or reputation of the owners or employees. But that provision actually got removed.
Removed. Why?
Lobbying. Plain and simple. It shows just how important PT has become and the constituency behind keeping it.
So putting it all together, even if Congress does raise the SALT cap someday, say to $40,000, PT is still going to matter.
Absolutely essential, I'd say. Because of that MAGI phase-out we talked about, if your income is high enough, that $40 K cap could easily phase right back down to the current $10 K floor.
So if you had, say, $650,000 in AGI,
You'd likely get no additional benefit from the increased cap. The phase-out would wipe it out, which means PT remains the main, sometimes the only, way for many high earners to get a full federal deduction for their state income taxes paid through the business.
can you give us a sense of the numbers, like a real-world example?
Sure. Take a hypothetical S-Corp owner in California, making around $1.5 million in business income. By properly electing and using PT, their estimated federal tax savings could be somewhere in the neighborhood of $51,615.
$50,000. That's definitely not small change.
Not at all. It highlights why, despite the complexities, PTT is such a powerful tool for the right businesses and owners.
Okay, so let's wrap this up. Key takeaways from our deep dive today.
Well, first, PT is still a vital strategy if you're impacted by the SALT cap and own a pass-through business. Second, you have to pay attention to the specific rules in each state you operate in. They're critical.
Right, the patchwork issue. And compliance isn't passive.
Definitely not. It's an active year-round job staying on top of payments and elections. And finally, the legislative landscape is always shifting, so you need to stay vigilant.
Makes sense. It seems navigating this really requires proactive planning.
Which leads to maybe a final thought for you, the listener. In this constantly changing tax world, how are you going to proactively adapt your planning? How will you stay ahead of these changes to maximize benefits, instead of just reacting when new rules drop?